This morning, I'm going to be talking about what myself and my team have been putting together. It's our latest system, which is not quite ready for public availability just yet. I want to give you guys a little precursor as to what we're going to be having. You're the first ones to hear about this. Basically, what I have done, I've been trading for a long time, hedge fund manager, and right now my passion is really teaching others how to be a success in the market. I've kind of boiled it all down to three specific principles that really can be used in any market. And I'm titling this The Ultimate Guide to Entries and Exits. The Ultimate Guide to Entries and Exits. Now, Renee touched on most of these things. I've been trading for 35 plus years. I'm not just a teacher who doesn't know how to do. I'm a doer who now, at this point in my career, is teaching because I have a passion for helping people how to navigate the waters of the markets. And it's not the easiest place to make a living. It's not the easiest place to earn money in the long run, but I have done it, and I know what it requires to become a success, and that's why I get a big kick out of working with people right now. I'm a keynote speaker with many of the companies that you see up here: TradeMonster, Money Block, Metastock, the Money Show. I've written many articles for the Money Show. Value charts and micro quants. I've written 3 financial books, and I am the founder and head trader at optionsinfinity.com. What you're going to be hearing today can be utilized not only in options, but in any market that has prices and a ticker. You know, if it follows anything, and I'm going to be showing you that as we go throughout the lesson here. If at any time you guys have any questions, and I have the question box up here in front of my face, if anybody has any questions, please go ahead and type those in the question box. I will stop my presentation and answer those right away. Because I want you to keep focused on what I'm saying. If you got a lingering question, I know that sometimes it's hard to have full concentration. So please feel free to interrupt me with a question, and I'll answer that as soon as I get a chance to. So the first question is it possible to rapidly become a profitable trader? Well, even if you've struggled in the past. And my answer to that is a resounding yes, yes. Rapidly is going to be, you know, all depending on the amount of time you're willing to put into it. I think it's possible for anybody to become a profitable trader. The first thing they need to do is kind of check their ego at the door. Your ego can get in the way of making good decisions in the market. And a good example of that is early on in my career, you know, I would look at a trade, look at a strategy and say, you know, this is correct. I am going to buy this. And the market would turn against me. And my ego said, how dare the market turn against me? What is up with that? And I would throw good money after bad. And you come to realize that the market has its own fuel, and that's the fuel of other investors' fear and greed. The market doesn't care about you. It really doesn't. So don't take it personally when the market goes against you. Have rules to get in and get out, and that's the important part. And you just check your ego at the door, and don't let the market trade you. You trade the market, and sometimes that requires patience. The next thing you need is a rock solid strategy. Now there are a number of strategies out there. Some of them are good, some of them are terrible. What you need to do is, and you might come up with your own strategy. What you need to do is test that strategy and make sure that has a positive expectation. I'll talk about that also later on. When you do, keep it simple and just execute those trades. And ultimately that is going to lead to success and profitability. Steve, good question. Please expand on your definition of ego. My ego is that my ego tells me that I'm the greatest trader in the world, but the market tells me I'm better than you are. Your ego tells you that most times it tells you, and it gets away in the way of good trading. It tells you that you're better than you are sometimes. Sometimes you have to pull back and stay within what you know how to do. Stay within what you know how to do. And here's another comment that Robert came through, and he says the market always will be there. It does require patience. Absolutely. Absolutely, it does. I couldn't agree more with you on that one, Robert. Okay, today what I'm going to be talking about is three principles, the three principles that I know work, that I teach, that I trade by. And I'm going to show you how they apply to all the markets. We're going to actually go through a walkthrough of what I use to enter and exit the markets. Then we're going to talk about some real-time trades. We're going to go over to Thinkorswim, and I'm going to show you some of the charts. I'm not an affiliate with Thinkorswim. I just happen to believe that they're one of the best trading platforms out there available today. Their charting tools are fantastic. They're fantastic. Can you use this in Forex? Absolutely. Absolutely. And that's one of the reasons why right now in Options Infinity, we are expanding beyond options, and we're teaching people how to use these principles in all markets. And Forex is one of the ones we're looking at. Forex is it's absolutely the biggest market on the planet. The stock market, there's about $500 billion that trades hands in a given day. $500 billion. The Forex market is 3 trillion. 3 trillion. Believe it or not, the Forex market hasn't been around for very long. It basically is trading currency pairs, the US dollar versus the Japanese yen, the US dollar versus the Canadian dollar, and so forth. I'll show you a chart of that as when we get over into the some of the examples. Okay, my three principles, and my mentees that have been working with me for years know these principles inside and out, and they've seen them in action. They are the regression channels. Regression channels. measured moves. I use the regression channels to enter a trade. When are we getting ready to enter a trade? I use measured moves to not only pinpoint the time that I want to get in, but also manage the trade. And the exit is I use Fibonacci extensions. When the Fibonacci extensions have reached the 127 or the 161, I know that the market is probably going to run out of gas. Probably going to run out of gas, and it's a good time to take some profit. Now, but we also have an exit when we're losing strategy, and that is when the measured move goes opposite of where we think the market is going to move to. Okay, so these three principles, that's what we're going to focus on today. The regression channel for entry, the measured moves to manage the trade, and then the Fibonacci extensions to exit the trade. Regression channels. Okay, first of all, there's a regression line is calculated by taking 50% of the price at any given time, 50% of the price action below the line and 50% of the price action above the line to create this middle line or the mean. And this is a very powerful trend line. Okay, and it's basically I used to do this by hand, and that's why I'm so impressed with some of these trading platforms, how they can update the regression channel even on a minute by minute or tick by tick chart. You can use regression channels on any time frame, and sometimes I look at for longer term trades, I'll look at maybe the 1 year daily chart, and then to really get in, I'll look at maybe the 10-day 30-minute chart, and sometimes they're diametrically opposed. But I look at the longer term chart as being the trend that it's in. In the short term, if it's diametrically opposed, might be saying, well, short term it's going against us, but this might be a good time to get in on the longer one. And here's just the regression line. It's been plotted on Google, Alphabet. And this is a 1 year daily chart, Google being a NASDAQ stock. And you can see that, visually, you can see that you've got 50% below, 50% above. What I find most interesting here is that notice the slope of this line. The slope of this line. Google has been in an uptrend for longer than a year, but we're just looking at the 1 year plot here, and it is definitely moving up. So this is an excellent trend line. Okay, now once you have that trend line established, we're going to throw some statistics at it. And according to, you've probably all seen the bell-shaped curve, and that is when you have plus or minus 1 standard deviation, 68.2% of all the prices will be contained within that data, or within in the two lines. This is not only good for prices, it's used for any data where you've got a statistical database. You can run plus or minus 1 standard deviation on there. But 68.2% is, that's pretty awesome to think that this channel contains that amount of prices. So when we start applying these statistical plus or minus 1 standard deviation, now you're starting to get a little bit more better picture of Google and how it trades. Okay. Once we saw this regression line, it was obvious that we're in an uptrend. Now with the plus or minus 1 standard deviation, you can see that, well, Google has a tendency to, when it gets up around this area, it wants to revert back to the mean. It wants to revert back to the mean. Okay, so the more you look at this, the more you see what is going on the chart. It's giving you more information, more information. Now, when you go to plus or minus 2 standard deviations, statistically, that is showing that 95.4% of all price action is contained within the 2 lines. 95.4%. And I know some people say, well, this sounds too good to be true. I mean, wouldn't it be more like 50%? No. You can't go against mathematical statistics. That it is a fact. It is a fact. And as a trained engineer, I know the statistics is just like some of the laws of physics. It's how the world revolves. Okay. And when you have plus or minus 2 standard deviations, you know for a fact that 95.4% of all price action will be contained within those channels. And the fact that 80% of all traders fail is due to not statistics, but to ego, over trading your account, not having a strategy. There's any number of reasons why the statistics that most traders fail is so high. Okay, here's Google with plus or minus 2 standard deviations. Now we're getting a real good picture at how we want to trade Google. Because when it comes up around here and it comes down around here, we know it's overbought and oversold. You say, well, is this contrarian trading? Not really. This is using statistical tool to look at the probability of an event happening in the future. And there's not many indicators that you can use that can give you a good feel for what's going to happen in the future. Regression channel is one of them. If it is overbought or oversold, it's going to revert back to the mean. It's going to revert back to the mean. Then it's up to you to take advantage of this. Now, occasionally you'll get an outlier, and that's okay. You get an outlier, that really piques my interest, because when I've got an outlier, it's like, okay, I know it's going to turn around. It's just a matter of when. It's just a matter of when. And that's when we enters measured moves, and we'll talk about that in a second. But okay, so now we take a look at our Google chart and we say, well, let's sell. Let's sell our Google. Let's buy our Google. Let's sell our Google. Let's buy some more. Let's sell. These are all profitable trades just by using the information from the regression channel. So this is Google. This is Google. How about other things? How about the SPY, the ETF of the SPX, which is the Standard & Poor's 500? Same thing. Same thing is true. I use this for trading the SPX on the weekly options. Okay, you can see here's it's oversold, overbought, oversold, oversold. Okay, and you can utilize these points to get in to trades. This is the regression channel is statistically the best way to enter overbought and oversold markets. It's the best way to enter overbought or oversold markets. Okay, principle number 2 is measured moves. Measured moves. Measured moves help you to trade with the trend. Let me go one slide ahead here. An uptrend is defined as higher highs and higher lows. Okay, so let's go back and let's take a look at this. This is a bullish measured move. And what you do is you plot a low point here, then an intermediate high, then a pullback that makes a higher low, a higher low. And then when it crosses the B line, it has made a higher high. That's the classic definition of an uptrend. You've got higher lows and higher highs. And as long as it stays, and you're liable to get many of these as it's going up. And as long as you're in that kind of a movement, you know that you're in an uptrend. Just stay with the trend. Now, you can also see measured moves when the market turns around. Let's say it's up around here and it comes back down. Okay, pulls back, but it makes a lower high, and then a lower low. That's the classic definition of a downtrend. As long as you continue to stay with that downtrend, you continue to trade with the trend, trade with the market. So looking a little closer with the bullish measured move, like I said, this can also signify that you've been coming down. Let's say you hit the -2 on the regression channel. You get a measured move. Things have turned around. Okay. Now, occasionally, let me get my pen up here. Occasionally, it will come up here and do this. Well, what's that? That is not a bullish measured move. It never made a higher high. As a matter of fact, it made a lower low. So this is a continuation of the downtrend. All right. This is also the time to get out. You might have gotten in right around here and said, I'm going to go, and I think everything's telling me to get in with a bullish trade. And then all of a sudden it does turn around and go down here and make a lower low. Okay, that's a continuation, because remember, to get to point A, you've been coming down. Okay, so now what happened here is you didn't make a higher high. You came back and made another lower low. So the trend is down. This is a great point to exit with a loser. Okay, just the opposite is true with the bearish measured move. You get lower lows and lower highs, and once again, this will signify a downtrend. So if you're overbought on the regression channel and you come up and you see a measured move, you've got pretty good confidence that things have turned around and it's reverting back to the mean. Here's the Google chart we had with the regression channel, and now I'm going to put on some measured moves, and let's see if it tells a little bit more information. Okay, here's a measured move here that comes down. We got a series of up measured moves, and the trend is continuing to go up here on Google. Let's take a look at the SPY and see if we can see the same thing. Absolutely. Here's a measured move and a strong move to the upside. Here's an outlier above the +2, comes down, makes a measured move right here, comes all the way down, makes another measured move all the way down to the -2. Then we get a measured move up, then we get a measured move down. Okay, this is a great tool in conjunction with the regression channel to tell you when to get into a trade. And once you have that, we're going to be able to do the next thing. And the next thing is to look at Fibonacci's. So the conclusion on measured moves are the best way to quantify a trend once you're in a trade. Principle number 3, Fibonacci extensions, and this is what I use to exit a trade. Fibonacci was a mathematician who developed a number sequence that when you take the current number divided by the previous number, you're going to come up with a ratio of 0.61. 0.61 is called the golden ratio. The golden ratio can be seen throughout nature. If you take the distance from your elbow to your wrist, okay, the distance of your forearm, and divide it into the distance from your wrist to the tip of your finger, that will be 0.61. Most of the major bones in the human body grow according to the Fibonacci ratio. The leaves on the stem of a flower grow in proportion to the golden ratio. The spirals on a seashell grow in relation to Fibonacci's. Now, mathematicians later came along and they said, okay, I'm going to take the square of that and the square root, and then I'm going to take the reciprocal. And they've come up with the 127, the 161, and the 261. And these are defined as Fibonacci extensions, okay? So in any trading platform, you just come to A, click on A, drag to B, click on B, drag to C, and it'll automatically put in the 127, 161, and 261. Now, the 127 happens, of course, more often than the 161, which happens more often than the 261. These are the two I really focus on. One of the things I know is when it comes to the 127, it's either going to consolidate, it's going to push on up, or it's going to revert back. Okay? The 127, I target most of my profit to be taken right at that point. Occasionally, you'll see it blow right through the 127, and you know it's going to go to the 161 and do the same thing. It's either going to consolidate, it's going to either blow through that, or it's going to pull back. If it blows through this, sometimes it'll go to the 261. These are uncanny. The more you plot these on a chart, the more you're going to be amazed at how accurate these are. And doesn't it make sense? Doesn't it make sense that if the Fibonacci ratio is seen throughout nature, that it would be seen within the stock market? I mean, there is a melting pot of human nature. You've got fear and greed just bubbling over, and the Fibonacci's are measuring that. They're measuring that. Play with that and try that. You'll be amazed at how accurate that is. Okay, so here's our Google chart. So here's the move we had off the overbought situation. Came down, made a major move right here. I put a Fibonacci in here. There's the 127. And believe it or not, sometimes it's just unbelievable. It'll come within a tick. It'll come within a tick. Okay? So what makes a market that's roaring down come within a tick and revert back? Fear and greed. Fear and greed. Okay? Then it moves up from the -2, makes a measured move. There's the 127, bam. All right? Second measured move, 127, bam. Third measured move, 127, goes right through the 127 to the 161. That's Google. How about ASPY? Absolutely. Measured move, 161. Gap through the 127, went to the 161. Measured move, 127. Overbought. Measured move, blast through the 127, blast through the 161, 261, brakes are put on, but then it continues on down to the -2. Measured move, 161. All right. Measured move to the downside, 161. 261 as it gapped through that. So in conclusion, the Fibonacci extensions allow me to preset price targets for my exit. Now, what's cool about these principles is once you get into a trade, as soon as you get into a trade, you can preset when you're going to exit with a profit or when you're going to exit with a loss. The exit is sometimes more important to profitable trading than the entry. All right, here's a little chart you can use to walk through this. I'm going to start out if the price moves to the plus or minus 1 or 2. Now, the more you see this, the more you'll see that like Amazon usually reacts to the plus or minus 1. McDonald's reacts to the plus or minus 2. The more you see these, and that brings up a point, I like to keep my market basket relatively small so that I'm familiar with what the charts look like and what they're telling me. Once I see that, I know that it's time to get in. And a lot of times I'll wait for a measured move to occur, and that's the entry. That's the entry. Then I'm going to let my profits run until I get to the Fibonacci price of 127, 160, 161, 162. Okay, then I'm going to exit. Or if buying or selling pressure is just too great and we make a major move against, I'm simply going to kill the trade and exit. See, there's no ego involved in this. This is a mechanized system. You know what you're looking for when it reaches the overbought and oversold conditions. You know how to look for a measured move. Once you're in a trade, you can go ahead and automatically preset where you want to take profit and where you want to take a loss. There's no ego involved in this. If a trade goes against you, you're out. Simple, plain and simple, you're out. Okay? You're minimizing your losses and you're letting their profits run. So is this good in all markets? Absolutely. Absolutely. I use this in the stock market to buy and sell. And I'm usually looking at a chart that's the 1-year daily. I use this with weekly options, usually the 10-day, 30-minute with leaps, 1-year daily, futures and ETFs, 10-day, 30-minute. And these are all credit spreads. One of the nice things about credit spreads is rather than buying a straight call or put, you're not, with a straight call or put, it not only has to move in the direction you think it's going to go, but it has to go quickly because time erodes a portion of the premium you paid, and it's called the intrinsic value or time value. Okay, in Forex, I look at the 10-day, 30-minute chart, and I'm either going to buy or sell with the Forex. Now, I don't like to get into, you know, I know there's some trading platforms that allow you to do 5-minute trades on Forex. That's kind of ridiculous, really. I mean, you know, give the trade a chance to run. So kind of stay away from those gambling situations with the Forex market. Okay, here's some examples. The SPX, it was down to the -2. It had a major move to the upside. We entered, we put in a bull put, and it came up to the 161, and we exited. And this was an actual trade we did on Thursday, August 2nd of this year. 11 o'clock, we went in with a bull put where we sold the 10 August 2800 and we bought the 27.95, 5 points apart. We got a 70 cents credit. We exited the next day at 10 o'clock. The debit was then 10 cents. We had made 86% on that trade by using the principles that I've just discussed. Carlos, I'm not sure I understand you. You said I answered it. I hope I did. How long in the past do you go to make the linear? See the okay, depending on what I'm trading, is the time frame that I'll look at the regression channel. So I'm looking on futures and ETFs and Forex, for example, I'm looking at the very short term, whereas stocks, I'm looking at the long term. And so for stocks, I'm looking at, let's see, wait a second, where'd it go? Oh yeah. So for the SPX, the weekly options, I'm looking at actually the 10-day 30-minute, and for stocks, I'm looking at the longer term chart. Okay, and here's one for Rockwell Automation that was an outlier. This is an outlier. Okay, came up, made a measured move, came up to the 161, came all the way up to the +1 on the regression channel. Okay, this is stock. We entered May 2nd at 168. We exited May 21st, 3 weeks, and took almost 9% to the bank. Well, 9% in a year for a lot of traders is a fantastic year. This was 3 weeks. This was 3 weeks. Okay. Okay, so let me go over to, I'm going to bring over my Thinkorswim platform, and let's see if I can pull that over. It's a little big here, but you can see here's Google, and these are actual trades right now, or this is real live regression channels. Measured moves, Fibonacci, and you can see how profitable this is. I use usually the longer term to kind of zero in on what trade can be made, and then I'll go to the shorter term to say, does it make sense? Is it overbought, oversold on the shorter term? So let's just take a quick peek at the U.S. dollar versus the Japanese yen and see if it makes sense here. Absolutely, same things going on. Here it is oversold. Okay, what a great time to get in and buy the U.S. dollar Japanese yen pair. And by the way, Forex is traded 24 hours a day. However, the majority of the Forex trading is done from 8 o'clock until 5 o'clock Eastern time. Okay, don't worry too much about overnight trading. It's not, yeah, there's things that happen, but you don't have to stay awake all night, especially if you're using this strategy, because hey, this is oversold right here. I'm going to just go in and I'm going to buy this pair and let her rip. Okay, and this was about let's see, 105. That's about 120 pips, which is a very nice trade. It's a very nice trade, and it only happened in 3 or 4 days. Okay, let's take a look at McDonald's. You can see how it goes from the +2 to the -2. Right now, it's right around the +1, and I'd let McDonald's go a little bit more if I had this McDonald's stock, because a lot of times it'll get up around here, and sometimes it even is an outlier. This works in all markets. Okay, Ed, Thinkorswim does not list regression channels as an indicator. Okay, you're absolutely right. Let's go over and let me show you that. Let's go over to, let's see, what do I need to do here? I need to blow this up a little bit, and then come over to style, and then come down to, not style, setting, or studies. Edit studies. Okay. What you're going to do is come down here on the left-hand side, and you're going to look for standard deviation channel, standard deviation channel. Okay, that's what you want. That's what you want. And notice I have one at the plus or minus 2 and one at the plus or minus 1. So this will put your standard deviation channel on. Okay, Ed? Okay, cool. All right. Excuse me. So you think about a realistic expectation, and why does the casino always win? Why they always win is they have an edge. An example in roulette, there are 36 numbers on the wheel. Then there's a 0 and a double 0. If it hits 0 or double 0, that goes to the house. Okay, so that's their edge. You got 36 numbers, 18 red, 18 black. If you bet red, your win rate is 18 divided by 38, 47.3%. The casino's win rate is 20 because they have the 0 and double 0, or 52.6%. They have a 5.3% edge. And what they do is they just want people to just come in left and right. They'll give you free drinks, free food, anything else. So you will bet against the house because they know in the long run, they have an edge. Every one of the casino games is like this. What we need in trading is to have an edge. Your edge in a 50-50 game is either you win more than 50%, or when you win more than when you lose, okay? Or you want both, all right? And I just want to show you an equity chart for one of the strategies we use, and that's weekly options. And these are actual trades from June of last year to June of this year. So I'm better than 100% based on a $25,000 portfolio where we're only putting $1,000 per trade, not $25,000 per trade, $1,000 per trade. And we made over 100% using a very conservative trade size. Now, remember, past performances is no guarantee of future results. So, I want to show you our website. We've changed things up lately because we're getting ready to introduce this. You're one of the first groups that I've introduced this to. We can begin learning at optionsinfinity.com. So you just want to go to optionsinfinity.com, and that was my granddaughter, my youngest one. Let me see. Let me bring this up and bring this over, and there is optionsinfinity.com. This is the home page. Unlock profits from any market, and we're not ready just yet. You guys are getting ahead of the game, but you can click on the ultimate guide and learn more about what we have to offer. Okay. Or you can go back here and learn a little bit more about my story. And, you know, I haven't always been profitable. I got, you know, I hate to say it, but I got my teeth kicked in many times in the market, and stayed with it, and became a success. And now I'd like to help you guys out with that. So you want to learn more, just go to www.optionsinfinity.com, and that'll get you started. And remember, the you know, what you're going to see here is because it's not fully ready yet, we've got an opportunity for you to get the ultimate guide and then the entry exit master class and you'll be surprised at the master class. And somebody's saying, well, you know, how much is the master class? Well, you'll be surprised. Let me just put it this way. You will be surprised at how inexpensive this is, because I am committed to your success.